The stock market can often feel like a complex puzzle with countless moving pieces and shifting patterns. But sometimes, the smartest move is to step back, take a breath, and look at the big picture, seeing how all the pieces fit together before making your next move. On Wednesday, August 20th, 2025, Wall Street is moving with caution. Imagine a driver gently tapping the brakes before a sharp turn, alert and ready for what's around the corner. That's the mood on the trading floor today, careful, measured, and watchful. The S&P 500, NASDAQ 100, and Dow Jones are all slightly lower this morning. But this isn't a sign of panic or fear. Instead, it's a collective pause, as investors hold back and wait for important news that could shape the next chapter for the markets. Yesterday's market performance was a mixed bag. The S&P 500 and NASDAQ slipped a bit, while the Dow managed to eke out a small gain. It's a reminder that not all parts of the market move in sync, and sometimes even on the same day, optimism and caution can exist side by side. This split in performance shows that investors are wrestling with uncertainty. They're weighing the hope for growth and strong earnings against the reality of potential risks and challenges ahead. It's a tug-of-war between optimism and caution, and no one is quite sure which side will win out. The hesitation in the market comes from two major clues on the horizon: a highly anticipated Federal Reserve report and earnings results from big-name retailers like Target. Both have the power to shift the mood on Wall Street in an instant. The Federal Reserve's upcoming report will offer a window into their thinking about the economy, inflation, and interest rates. Investors are eager to know if the Fed will signal any changes in policy, or if they'll stay the course for now. Meanwhile, Target's earnings will provide a snapshot of how much Americans are spending. Consumer spending is a key driver of the U.S. economy, so these numbers matter, not just for Target but for the broader market outlook. It's important to remember that markets don't move in a straight line. There are always pauses, pullbacks, and moments of uncertainty. These pauses are not only normal, they're healthy, giving investors time to digest new information and adjust their strategies. Right now, investors are carefully analyzing the latest data, reviewing reports, and waiting for the next wave of information. They're not rushing to make big moves. Instead, they're taking a thoughtful, measured approach. They're keeping a close eye on the health of major companies, signals from the Federal Reserve, and the latest readings on consumer confidence. Each of these factors can tip the balance and influence what happens next. It's a delicate balancing act. The market is holding its breath, waiting to see which way things will tip, toward renewed optimism or a more cautious outlook. This week is all about patience and preparation. Investors know that reacting out of panic rarely pays off. Instead, they're getting ready, staying calm, and waiting for the right moment to act. The next moves in the market will depend on what these key reports reveal. Will the Fed's outlook reassure investors or spark new concerns? Will strong retail earnings boost confidence, or will weak numbers raise fresh doubts? For now, everyone is watching, waiting, and preparing for what comes next, knowing that in the world of investing, patience and perspective are just as important as timing. The Federal Reserve, often called the Fed, acts as the economy's main mechanic, constantly tuning the engine of growth and stability. Its decisions ripple through every corner of the financial world, from Wall Street to Main Street, affecting everything from mortgage rates to the cost of groceries. The Fed's most powerful tool is the interest rate, which it can raise or lower to either cool down an overheating economy or jumpstart a sluggish one. Every move is watched closely by markets and policymakers alike. This week, all eyes are on the minutes from the Fed's last meeting. These documents offer a rare, behind-the-scenes glimpse into the central bank's internal debates and the reasoning behind their latest decisions. For most of 2025, the Fed has kept interest rates steady, signaling caution. But at the last meeting, two governors broke ranks and dissented, a rare public split that has investors buzzing about what's really happening inside the Fed. This dissent signals a real debate at the heart of the central bank. Should rates be cut to give the economy a boost and support job growth, or should they be held steady, or even raised, to keep inflation in check and prevent prices from spiraling out of control? Chairman Jerome Powell has struck a cautious tone, voicing concerns about persistent inflation, especially as new tariffs and global pressures threaten to push prices higher. He's made it clear that the fight against inflation isn't over yet. Investors are anxiously hoping the minutes will reveal which side of the debate is gaining ground, and whether a shift in policy is on the horizon. Right now, the market is betting on a rate cut in September, with traders and analysts pricing in a move that could lower borrowing costs and potentially lift stocks. Some even expect another cut before the year is out, hoping for a more supportive environment as economic uncertainties linger. The release of these minutes could either confirm those expectations or upend them, sending markets scrambling to adjust. And with Powell's highly anticipated speech at the Jackson Hole Conference just around the corner, every word he utters will be dissected for hints about the Fed's next move. In this environment, every sentence, every pause, and every nuance matters. Investors, analysts, and business leaders are all searching for direction, trying to read the tea leaves of Fed policy. The Fed's next move could set the tone for the rest of the year, shaping not just markets, but the entire economic landscape ahead. Interest rates are the cost of borrowing money, and they play a crucial role in shaping the financial decisions of individuals, businesses, and even governments. Whether you're taking out a mortgage, financing a car, or using a credit card, the interest rate determines how much extra you'll pay over time. But interest rates don't just affect personal finances, they're a powerful lever for the entire economy. When the Federal Reserve, often called the Fed, changes interest rates, the effects ripple through every corner of the economy. The Fed's decisions can influence everything from how much it costs to buy a home, to the price of groceries, to the health of the job market. Lower rates make borrowing cheaper for banks, businesses, and consumers. Think mortgages, car loans, and credit cards. This means people are more likely to take out loans, buy homes, or invest in new ventures. Cheaper borrowing encourages spending and investment, fueling economic growth and job creation. When money is easier to access, businesses can expand, hire more workers, and innovate, while consumers feel more confident making big purchases. For the stock market, lower rates are usually good news. Companies can grow more easily and stocks look more attractive than bonds. Investors often shift their money into stocks, hoping for higher returns, which can drive markets higher. But when the Fed raises rates, borrowing gets pricier, spending slows, and inflation is tamed. Higher rates can cool off an overheated economy, but they also make it harder for people and businesses to borrow and spend. The Fed is walking a tightrope, trying to keep economic growth going without letting inflation spiral out of control. It's a delicate balance, and even small changes can have big consequences. The big question now is whether the economy needs a rate cut to boost growth, or if the Fed should remain cautious to prevent inflation from rising again. Investors, businesses, and everyday Americans are all watching closely. If the Fed hints at cuts, markets will likely rally. Investors see lower rates as a green light for growth and higher profits. Optimism can quickly spread, lifting stock prices and boosting confidence. If not, investors may be disappointed, and markets could react with volatility or declines. Uncertainty about the Fed's next move can make everyone nervous, from Wall Street traders to small business owners. That's why this week's Fed minutes and speeches are so critical. Every word and signal from the Fed is analyzed for clues about the future direction of interest rates. The stakes are high for everyone, from Wall Street to Main Street. The Fed's decisions affect not just investors and big corporations, but also families, workers, and small businesses across the country. The Fed's decision will shape the economic landscape for months to come, influencing everything from job opportunities to the cost of living. That's why, right now, all eyes are on interest rates. To gauge the economy's health, look at how much people are shopping, especially at Target. Target's quarterly earnings are a key indicator of consumer confidence. Analysts expect earnings of just over $2 per share on $25 billion in sales. The big question: can Target reignite growth after years of flat sales? Challenges loom: slowing online sales, tough competition from Walmart and Amazon, and rising tariffs. Tariffs hit Target harder than rivals, since half its products are imported. Higher tariffs could squeeze profits or force price hikes, risking customer loyalty. Investors want to see if Target can adapt and stay competitive. This report is a snapshot of American spending habits right now. Target's earnings aren't just about one company, they reflect broader economic trends. Strong results mean successful strategies and likely higher stock prices. Weak results raise concerns about competition and consumer spending. Investors will scrutinize online sales, profit margins, and future guidance. For shoppers, Target's health affects prices, promotions, and store experience. If profits are squeezed, expect fewer deals or higher prices. Target's performance is a window into how confident Americans feel about spending. It's a key signal for the entire economy. Another major story: the US government may take ownership stakes in top semiconductor companies. Semiconductors power everything from phones to military tech, making them vital for the economy and security. The CHIPS Act aims to bring chip manufacturing back to the US with billions in subsidies. Now the government is considering taking equity in companies like Intel, Micron, TSMC, and Samsung. This would give the government influence over critical tech and protect taxpayer investments. The goal: ensure advanced chips for national security and keep sensitive tech out of the wrong hands. It's a bold move, blurring the line between public and private sectors. The outcome could reshape the future of American technology. Elon Musk is always in the spotlight, but recently it was for politics, not rockets or cars. Musk floated the idea of starting the America Party after a clash with President Trump, but he's now put those plans on hold. Running a political party is a massive distraction, and Musk wants to focus on his companies. Avoiding political battles also keeps him in good standing with both parties, crucial for his businesses. Tesla investors are relieved. They want Musk focused on innovation, not politics. Running Tesla is demanding, and shareholders want his full attention. By shelving his political ambitions, Musk reassures investors and keeps his eye on the company's future. For now, business comes first. Target isn't the only retailer in focus. Home Depot, Lowe's, and TJX companies are also reporting earnings. Home Depot's results were steady, signaling consumers are still investing in their homes. Lowe's and TJX will offer more insight into home improvement and discount retail trends. This earnings season, companies are beating expectations by the widest margin in years. It shows either analysts were too pessimistic or businesses are more resilient than expected. Despite higher rates and global uncertainty, many companies remain profitable. This resilience is a key reason the stock market has held up. As more reports come in, we'll see if this strength continues. Retail earnings are a crucial piece of the economic puzzle. This week's headlines: Fed debates, retail earnings, chip policy, and Musk's decisions are all connected. The Fed's moves affect your loan rates and savings. Retail earnings show if Americans feel confident enough to spend, driving the economy. Government action on semiconductors shapes tech and security for the future. Musk's focus on Tesla reassures investors and employees. All these threads shape your financial world, whether you're an investor or just planning for the future. Understanding these stories helps you make smarter financial decisions.